The Dow and S&P closing at records, and Chinese markets largely positive after the country's finance minister signaled stimulus is on the way, though the announcement did lack details. That was over the weekend. Those comments led Goldman Sachs to raise its Chinese GDP forecast of 4.9%, though. Joining us now is Mark Mobius. He is chairman of Mobius Emerging Opportunities Fund. Mark, it's great to have you back on the show. I mean, you've been on in recent months, and you've said you thought China was, again, investable. So I want to start with your thoughts on what we did get from the Minister of Finance over the weekend, because we really didn't get much in terms of details around fiscal stimulus, but we did get a promise that there will be more specificity at the end of the month. Meantime, we did get some economic data, including CPI, that was disappointing. So still investable?
It definitely is still investable. And the reason is that the government is determined to push this market up and to push the economy up. So what they're doing is having a vast change in the way of states and provinces can borrow. So we're seeing a big increase in borrowing by the various entities all over China. And the Chinese government is giving them much more leeway. Probably the most significant thing that happened is when Xi Jinping said, look, we're not going to hold you officials responsible for your mistakes as long as you are trying your best to push the economy upwards. That's a big, big change in attitude by the government. So I believe this bullish sentiment is going to continue. We've already seen a correction, as you know. We've seen this big 40-plus increase in the index. Now it's come down by about a quarter. But I think we're still going to be in a very bullish environment in China.
So maybe instead of using the term bazooka, which investors have been using for the better part of, 2 or 3 weeks, maybe we should be using something more, a steady drip or a river of stimulus?
Probably river is a better description. Yes, a river of stimulus by the government. And by the way, this is a sort of a self-feeding situation, because what happens when the index goes up to the extent that it did is it draws in more and more investors. Remember that half of investors, particularly in emerging markets, are index investors. They buy ETFs, they buy index funds. So when the index goes up, they're forced to put more money into China. So you're going to see more foreign money going into China in addition to the local money. Of course, the local money is really what drives the market.
Mark, I'm curious what this does, this move in China and change in sentiment around it, to Asia funds in general. Because, yeah, they got China in them, but they also very intentionally have stuff that's not China, often ex-Japan. Is that a way to hedge away from being too China-focused, given some of the governmental uncertainty there, but still lean into some of the follow-on effects of China getting that stimulus?
Well, you know, India has been doing so well. It continues on this incredible bull market, and we think that will continue because India is growing at 7-8%, incredible growth in the country. But as I mentioned, you know, when you have the China index going up the way it did, it impacts the emerging markets index because China represents something like 30% of the index. That means more money has to go into the index, which means more money goes into places like Thailand, Vietnam, Korea, all these other emerging markets, and of course India. So yes, you have the rising water will rise all boats. You're going to see an increase in money going into emerging markets generally.
But what I mean specifically is on those Asia ETFs and some of those funds, do you end up with a little bit of a built-in hedge because they're not just focused on China, or is it all going to get, the wagged by the dog in this case?
No, I think it's a very good point. It's always good to be diversified. So if you're in an Asia fund, you're probably better off, you're safer than being in just China, because you're getting India, you're getting other countries in Asia that are going very well. Don't forget, if you consider Taiwan part of China, Taiwan is doing exceptionally well. Even before the big downturn that we saw in China, Taiwan continued to do very well. So it's a good idea to be diversified in an Asia fund. which includes all these countries.